We're live. All right. Um, we'll give folks just a minute to join. We're going to be streaming this on YouTube and Twitter or whatever it is they call it these days. I just probably will always refer to it as Twitter. So thanks for joining us, everyone. Thanks, Claudia and Ophir. As always, appreciate you guys taking the time to try and educate our audience on macroeconomics and how it impacts markets. Claudia Sahm is the chief economist for New Century Advisors, and Ophir Gottlieb is the CEO of Capital Market Laboratories, and they are our recurring guests on our macro and markets monthly, or I guess now sort of quarterly episodes. So thanks, guys, and appreciate you joining us. Claudia, we'll start with some congratulations for you. How cool. Claudia was named one of MarketWatch's 50 most influential people in markets. And this is a list that has Fed Chair Powell, Ryan Cohen, Roaring Kitty, Elon Musk, Mark Zuckerberg, both presidential candidates, Claudia, you, and strangely not Chair Gensler.
He didn't earn it. No,
He didn't earn it.
Yeah, no. The article opens what do Bill Ackman, Claudia Sahm, Keith Gill, and Jensen Huang have in common? And I'm like, whoa, not much.
I
I
want to
don't
know,
know,
yeah.
but it was very, no, it was very sweet, and I knew a few months ago that I was going to be in the list, and had Greg Robb was the reporter because he's the Fed beat reporter, so we met a couple times, and I really don't like profile pieces because like it's about my work and not about me. And yeah, yesterday I started my first day of chemotherapy, and it was kind of nice to look on my phone and see something happy. I've gotten a lot of happy thoughts, but I had one person text me last week when he found out this all moved very suddenly, and he's like, "Look, he's like that one economist you don't like. He's kind of like a tumor, and you beat him up." So I was like, "Oh, how sweet." So I'm gonna work, but yeah, it's been a lot of roller coaster. But I'm thrilled that I'm being helpful. I mean, those lists are always kind of a little stupid, but like it's neat. I'm excited.
It's still cool. It's
Yeah,
pretty
it
cool,
really
It's
right?
is.
very cool and well
Yeah,
deserved, and yeah,
Thank you.
absolutely.
100%,
And you
100%.
really you brave the wilds and take the time to try and get good information out there. And this is one example, but I see you on social media doing it all the time. So
Yeah,
we
thanks.
very much appreciate it, and clearly the public very much appreciates the efforts that you're putting in.
Yeah, thank
Yes,
you.
yes.
Sure thing. So let's talk the Fed. Um, we last spoke in April, and at that time, we all agreed interest rate cuts should be imminent. Probably weren't. There was concern we were on our way potentially to a recession, and given that it was the early spring, the mood was a bit gloomy. So since then, July, the eponymous Sahm rule was triggered. Just a quick background that on this rule, Claudia developed this rule in 2019, working as the section chief at the Board of Governors of the Federal Reserve, and historically, the Sahm rule has shown that the initial phase of a recession starts when the 3-month moving average on the US unemployment rate rises by 0.5% or more from its 12-month low. Subsequent to that, in September, the Fed announced a 50 basis point interest rate cut. And I see we just lost Claudia for a minute, which we had expected because she was expecting an important phone call. So we're going to let her go off and deal with that for just a minute. So Ophir, um, what do you think about where we're at right now, given those two things? I think you seem like you're still. Are you still in the soft landing camp? You still think they might have pulled it off despite waiting way too long and possibly falling behind on the interest rate cuts?
I do. Yeah, it's you have sort of a probability diagram. I don't know if anything's the majority. It's like soft landing, no landing, hard landing, but it's the largest one. Yeah, I believe gun to head, had to choose one. Soft landing. What's very encouraging is that the Fed moved. Well, it's encouraging for me. For other people, it could be discouraging. I think they moved abruptly in September. By abruptly, I just mean a double size cut, 50 basis points, because I think they know they missed it in July.
Right.
So if I think they were supposed to cut in July and they didn't, but they cut in September and they did 2 cuts, I can't say, oh, well, because of those 2 months, we're now going to be in a recession. I have to lower my odds of recession. I think the Fed's on the ball. I think that there's other data which I mean, they're data dependent, so I'm sure they're aware of other things like actually just today, UK inflation finally, not only did it come below 2%, it's a 1.7%. Like sort of the shock. Canada's CPI, 1.6%, right?
Yep, under 2. Japan,
Yep.
same thing, right?
Japan. There's a target for PCE, which is 2%, and it's at 2.3. But when we get September's numbers, it's going to be, depends on if you're following the Cleveland Fed or Goldman. Goldman has it at 2.
I was going to ask about Goldman's estimate.
Yeah,
It seems a bit high, right?
Well, Goldman had it at 2.04 for
Okay.
a second, and so which would have rounded to 2.0, and then Cleveland Fed was at 2.06, which would have rounded to 2.1. So I'll let you decide. Let's say we're at 2.1 in September. There's no target for CPI, but we watch it. Okay, well, January of 2020, before COVID, or at least before we knew of COVID, we were at 2.5%. We're at 2.4 right now. There's no real target for producer price inflation, PPI, producer price index. But January 2020, it was 2.0%. Right now it's 1.8. It's in large economies, inflation is down. The Fed's almost at its target. Other measures of inflation that don't actually have targets, we're below where we were pre-COVID. We did it. I mean, it doesn't mean it's not going to be bumpy, but Dave, you've heard me say this many times. COVID was the irritant.
Mm-hmm.
The further we get from the irritant, the less irritated we will be. Well, yeah, lo and behold.
Less irritated. So, I thought it was funny. Someone on Twitter described the FOMC's new summary of economic projections as the closest thing to a mission accomplished banner you can imagine them unfurling. 2% inflation going forward, no slowdown in economic growth, and the unemployment rate staying low and falling. Seems like kind of exactly what you're saying as well.
Yeah, they did. I mean, this is nitpicking here. They've dropped their PCE, so their target inflation index PCE to be a little lower than they thought at the end of this year. So it was 2.6. They dropped to 2.3, which makes sense. There's going to be some base effects, by the way, for all of you. So when we get October numbers, which are going to be sometime in November, November, and December were very, very low last year. So when the year-over-year measure comes in, it's going to look like it's going up because very low numbers are going to get. But by very low, I mean for some of those months it was 0.
Mm-hmm.
But anyway, that's good. And the Fed in the summary of economic projections, they did raise their estimates for the unemployment rate by the end of the year, which is so funny because it just ticked down. So, but yes, it was a mission accomplished summary of economic projections. Yes.
And markets seem happy about all of this, right?
And the market should.
Yeah. Yeah. So what do you think? Like, we've been close to all-time highs for a bit, pulled back a little, but still like, hard to argue with where we're at right now. Market seems really bullish on the economy. Doesn't seem concerned about the election. Is this or war? Is this like continuing to climb a wall of worry, or is it really just there's a lot of pretty decent news out there and a lot of reasons to be optimistic about the economy over the next year?
I think it's the latter. Yeah, I think this is all probabilities. You know that, Dave. There's no certainty here. If there was, you wouldn't get the returns you get, but in a world of purely filled with suppositions of the future, and generally it's looking better. It's looking good. We're going to get some weird payroll numbers, some weird non-farm payrolls soon because of the hurricanes. And, the Fed is very data dependent. We don't even know. I don't even know if you can use the next non-farm payroll. Good or bad, just in a certain sense, just throw it away. But yeah, I think that the stock market is optimistic. I think the bond market's also acting appropriately, to tell you the truth. I think that yields, especially in the 10-year, should be rising. I never saw the argument when the 10-year was yielding 3.7 that it was going to go lower. That seems like a recession call if you thought the 10-year was going to go to 3%. The reason I bring up the 10 years is because it's what mortgages are based on.
Okay.
So I think mortgages have kind of hit a cycle low, to tell you the truth. And I know that doesn't sound very good because they've come back up, but I think that at one point you could lock in like 5.99. Like, I think that might be the best you're going to be able to do for a while.
Oh, geez.
And
but is that right? I mean, if you look at CME FedWatch, for example, I think actually I had it up. Now it's gone. But I was looking. Oh, here it is. Okay, so next meeting, market's pricing in a 25 basis point cut. Meeting
Yep.
after that, another one.
Yep.
Meeting after that, another one. Meeting
Yep.
after that, another one. Although it gets a bit more iffy. That's the March 2025 meeting where it seems like it's more of a coin flip for holding it or cutting. But that's another 75 to 100 basis points.
That's on the short end, right? So
on the short end, sure, but
yeah,
you don't think that's going to drag things in anymore?
No, I don't think it should on the 10-year. No, I really don't. I mean, we're supposed to have an uninverted yield curve, or the yield on the 10-year. So to borrow money for a longer period of time, it should be riskier than borrow money, let's say, overnight.
Sure. Yeah.
And it's been inverted, stays inverted. It will be uninverted eventually when the short-term rate comes down. I don't see an argument with the economy so robust that the yield on the 10-year should come down. I think 4% is about right. I mean, if the 10-year really starts dipping below 3.7, 3.5, that's probably a recession reaction than anything. We were used to this, such a low 10-year and such a low mortgage rate because of this zero interest rate policy we had for so long, but those days are over. And again, unless we hit a recession, we hit that because of a really bad recession. I don't think we're headed to recession. And I don't see a reason for the 10-year yield to go far below, let's say 3.7. It's sort of cycle lows. So I don't know if that's good news or bad news. I think it's good news because it means I don't think there's a recession. I guess it's not good news if you're hoping to get a 3% mortgage. I don't think that's going to happen. So.
Yeah, so that's interesting because, okay, you think that despite lowering short-term rates, we're not going to see much movement out on the longer end of the curve, and that's going to lead to a reversal of the inversion. And so traditionally, an inverted yield curve has most of the time, but not always, signaled a recession.
Yeah.
This time, it doesn't seem to have done that. And interestingly, you think it's going to be kind of sticky where it is. So that's what's going to lead to the
Yes.
reversal of the inversion.
The short rate's going to collapse.
Do you think that's going to blunt some of the effects of the rate cuts?
Sort of. So everyone focuses on the 10-year because of mortgages, but also, let's say, risky asset valuations. Like, what do you discount it with? But the short end is pretty important too. So the prime rate is specifically pegged to the Fed funds rate. Mm-hmm. So, and the prime rate is where businesses borrow. So right. that's going to be very supportive of the economy. Certainly for SMBs. You know, I talk to a lot of CEOs, and some of them have hundreds of thousands of SMBs that are customers. So they have a really good purview of, like, you know, where are they feeling, what is their sentiment, and they were worried that their rates were going to go up. Forget cuts. They were worried that we were going higher. And every company I know now is in the quiet period, so I can't talk to the CEOs. I have to wait for earnings to come out. But my guess is they're going to come back and say, yeah, our customers are feeling better. They don't think rates are going to go up. They think their borrowing costs are going to come down. That's the Fed funds rate. That's what we're talking about. Mm-hmm. So I don't think they're terribly concerned about the 10-year. I don't think they were terribly concerned about the 10-year.
So that's good. I think that's good to hear, right? That sounds like we're really finally looking at, let's say, more of a normalization. As you're saying, like, the zero interest rate environment was so distortive for so long. Again, we've said this at almost every episode, but it's still shocking to me that we're coming out of it without, a severe economic dislocation caused by, like, a policy-driven economic dislocation. Like, yes, there have been sort of what you would call exogenous. Oh, there she is. Welcome back, Claudia. No worries. There have been sort of exogenous economic impacts, COVID and the inflationary period that we just went through. But I think most economists would have thought coming out of zero interest rate environment itself, just to normalize policy, would have been extremely disruptive.
Well, so there's one thing we should remember. Everything you said is true. We kind of almost had that, and it's easy to forget the regional bank crisis. We actually almost had inversion causing a recession. We almost had great dislocations going from 0 to 50 very fast. So we actually did have it. And in that moment, it seemed like it was our moment. Like,
yeah.
And it didn't happen. It was the Fed backstop. It was FDIC. It was a bunch of stuff. And I think some people even misunderstood what the Fed was saying. It didn't really matter. There were some policies. And I think that was our moment. I think that was going to be our recession. I think that was going to be our great dislocation. I think that was going to be, see, inversions cause recessions. I think you see the Fed went too fast. I think it did happen. We just kind of salved it over.
Well, and that event was what happened with the the banks in the spring of 2023. That is such a good, like how how the Powell Fed reacted to that is such a good parallel to how the Powell Fed reacted to the labor market conditionings weakening. Like there was none of this at the time, and I frankly, when I was like, "You're gonna bail them all out, and you're gonna do for par," like what? It's like,
Yeah.
this is not. But they're like, we're not messing around, right? Like we could be all fancy and build little incentives in the game theory tree, and like this could be the big one, right? And so that was a place where, in hindsight, I said, okay, I mean, there's some moral hazard issues that this puts on, and the light did not shine brightly enough, long enough on supervision and regulation at the board, like that we never should have gotten to that place, but we did, and the Fed just swooped in, put caution to the wind, made it okay. And so I have a lot of respect for the Powell Fed. I can see a lot of, I mean, just having worked there for a long time, not just working for him, but the chairs before him through, he's different, right? And this risk management, that really is the thing. And when we saw, I was pretty adamant, as we got closer, I needed Nick Timrose's piece to really go for it, but I really felt like they were going to do 50 in September. And they did, and he sold it exactly the way, we are fighting from a position of strength, not weakness. And that is exactly what they were doing back in March. They didn't want to wait until the bottom fell out to do something. So it's an interesting, but no macroeconomic model like gives you those advice, right? Because it's a very the conditions flip from it's okay, it's no problem, to just like, whoa, go. And so I think it makes it hard. I like the Jay's style, but it's hard on markets, and they're not forecasters, and they've kind of given up on it, which I can understand, but it is causing a lot of disruption. I think it's not disruption like small banks failing, but like disruption of, markets moving on little data points and people arguing about the third decimal place, like that kind of stuff that I think they've created. But I really don't. I'm not sure there's a better way to do it.
Yeah, I mean, it's led to volatility, and yet at the same time, markets are doing as well as one could possibly think they would, right? Trading still near all-time highs and continuing to go up. One question I had for you, Claudia, about the 50 basis point cut is, do you think there was an element of shock value in their calculation? Like, do you think there's any chance they held off on the 25 basis points in the month prior in order to do the 50 basis points and really make a statement?
No, they're not that fancy. But what it was is in July, Powell didn't have the votes, right? It had, because for him to say, I thought at the July, well, I'm sure when we talked in April, we probably all agreed that when the Fed should cut or was likely to cut was in July. And it really, by July, we had started to say, hey, there's some stuff going here with the labor market, and you'd want to just do 25. And then Powell told us at the press conference, well, we talked about it. And we're like, oh, like you noticed too, but they didn't do it. And then you had 2 monthly payrolls report. You had a, preliminary revision to the payrolls. You had others that were all, like within that intermeeting period, they got a lot of very concerning news on the labor market. And so when he used, and I had my subsects, I was trying to help, push the vibe. We need 50 here. If we go in a little too long, and I don't think they were behind the curve. It's just like get going. He used the word recalibration. And with the Fed decoder ring on, what recalibration means is we should have gone in July, we didn't, and we're wanting to go in September, so we're just gonna put them two together. All is forgiven. Off we go. And I think not only is that a smart, I think that's a smart thing to do because it really was data driven. Like those 3 pieces of employment data were really important to that call. And it also didn't have this we're freaking out. When the Somm rule triggered and said a recession is here, I was very stressed. Just because if things were happening, but at no point did I say, oh yeah, we're in a recession. I knew that this was sending a signal that was it wasn't giving the full picture of the labor market because it was too simple. So, but I also knew the way the Fed looks at it, and they talked about this in speeches, we were not in a recession in July of 2024. I mean, that news about the unemployment rate and print came 2 days after the July meeting. So the calendar was not helpful to them. But that recalibration, which is a pretty, it's a really weak sauce Fed word, but I knew if he was going to get the votes, he needed something like that because you could bring in a lot of people into the tent. oh, but if I'd had the data, I didn't have the data, so that's why I didn't do it. I mean, like that's why that recalibration is important. And I thought he did a very good job. Maybe that was the market's reaction was, always is and was a little bit mystifying to him, but like he did a really good job of saying, do not expect these every meeting.
Yeah.
Expect cuts. Like he did thread the needle of, you should expect cuts. And I think he will fight for those because I think it's appropriate. But he really took the wind out of like, we're just going to do 50s. But they showed they would if they felt they had gotten behind. So I was so I was sitting on CNBC doing little spots with their mock panel, like right before and they bring me on as like the only economist that says he's going to go 50. So I'm sitting there like, oh my gosh, I'm going to. And they did. I was like, so, but it's not. But it's them again. It is them leaning so hard on the data, and they leaned so hard on the data, and that's why they didn't cut it in July, because they were just had this they were being very stubborn about their inflation forecast, and that'll bite you. But honestly, like the Fed's not who I worry about the most right now. That's comforting.
Yeah. No, that non-farm payroll report that they just missed, right? That just came right after, coupled with a much larger than expected revision downward. I mean, that I think if there was a magical world in that non-farm payroll report, even before it was revised even lower, had that happened 3 days before, they might have cut 25 basis points. I don't know.
Yeah, I really do think that payroll report would have potentially. It's always tricky, and we'll have this again when they get data right by the meeting.
Yeah,
it's not. I kind of wish they had blackout always, but like they need to have time where they're quick because they say things that are like volatility, but because the blackout went over time from a 1 year period or 1 week period to a 2 week period. They're like the CPI or the payrolls report frequently comes inside of the blackout, and like right now everybody knows they're data driven, but the Fed has not over time taught us how to read the data like they read the data.
Yeah.
I mean, you got to work there for a long time, and you got to want to read it like they do. Like, there's a lot of motivated listening and stuff. But that means if you get a major data release inside of the blackout, I think it's pretty clear I think given what we know right now, we are headed towards 2 more 25 cuts this year. I think the bar is really high for something. And it'd have to come in data, which are, by nature, backward looking. As they've already shown, if something would blow up in financial markets, God forbid, like they go to financial markets and they help.
Yeah.
So.
That's right.
So markets are pricing that in another 25 basis point cut in November and December. So you think that's pretty spot on.
Yeah.
They're, that what CME FedWatch says is that by this time next year, in fact, the money is literally in 1 year. The money is on a rate that's between 325 and 350.
I think that's probably.
Do you think is that where you think the natural rate should be? Is that like a good natural level, or does that feel right given if the economy continues as it is for the next year, and GDP continues growing at the same level, inflation stays around where it is, labor market stays around where it is?
I know you want to start with that one over here.
Sure. Yeah. I think so I think it's possible. It's hard for me to say what I think yet, to tell you the truth. The Fed has turned me into more, it's not even data dependence, it's like data obsessive. But so I will say this, the Fed sees R star, this fabled, natural rate of interest at 2.9. Right, we see that in the SEP. At least, that's the median of the projections. Okay, so does between 3.25 and 3.5 in a year make sense? Yeah, sure. I'm hopeful that whatever happens, and I think I'm willing to believe this, that whatever happens, it will be thoughtful. So it doesn't feel like their path is predetermined, but they have a map. So they know where they want to go, but they're totally willing to. They're like, there's too much traffic on this street, and they'll take a turn, right? That's what it feels like to me. Claudia brought up a really good point that in the regional banking crisis, they acted swiftly and aggressively. Blah blah blah, moral hazard, kind of as she would say, and they acted swiftly now, and they acted swiftly when did they? they acted abruptly when they were late with
Yeah.
inflation. Okay,
Mhm.
maybe swiftly is the wrong word, and they acted fairly abruptly now. So I feel much more comfortable with the Fed now. I mean, we can go back on our podcast, and I was
We were
doing many.
skeptics. Yeah, I
I
think all
was
of us
look.
were concerned.
I was really worried in July, and when the non-farm payroll came out, which is, wasn't very good, and then was revised lower, I was pretty worried. Like I'm a professional worrier, so I'm really good at it. I'm like really good at worrying. I'm like a pessimist masquerading as an optimist, and I'm good at that too. But I was that report and then the revisions worried me, and then what the Fed did, I basically I'm like jumping up and down on my seat, can't wait for earnings season so I can go back talk to the CEOs because they're in their they're in their quiet period.
Yeah.
I can't wait to talk to them, having spoken to their customers. I'm like one of the most excited earnings seasons of my life, just to hear what CEOs think now, given what they thought when I spoke with them last quarter when there were no cuts yet.
Yeah. No, I think it's if you look back and you look at the summary of economic projections, this long-term Fed funds rate, which is the R star, the neutral rate, you got to adjust for inflation, blah, blah, blah. Okay, so if you look at that, what the Fed has done in terms of forecasting, long-term interest rates over several periods ahead, or you can think of like what markets will forecast for 10-year treasuries, like you go in that space. For decades, I don't know, guys, you got to go 80s or so. Like you can go for a very long period of time where real interest rates were moving down, and like the forecast every time was, oh, it'll get back, oh, it'll get back, oh, it'll get. So you can like trace this little thing down, and then we got into the financial crisis, and after that they had the difference was like, and I did some of these forecasts at the Fed where I'm like, ain't going up. Like what are you gonna, we had GDP forecasts, and I'm like, I covered consumer spending. They don't have money to spend. What do you mean that's going to recover? You can't like, this is really rough. And so you had in the rate path, you saw a lot of like, oh, we'll have liftoff soon, we'll have liftoffs, and it didn't happen. It didn't happen. It didn't happen. So I mean, we know of like that you can do that with a lot of forecasts, but an interest rate, I mean, it's a really like deep feature of the economy, like time value and all of this stuff, and it's a price. Right, it's the price we pay to have something now that we want, as opposed to waiting until later when we actually can have it, without any borrowing and stuff. So it's really hard to estimate this, but even if you take a very simple approach to it, if you have a dynamic economy with high growth and high productivity, the rate should be higher. Like part of the low interest rates after the great financial crisis, that was a sign of sickness in the U.S. economy.
Right.
And so it's kind of like, if I had to pick R star, I kind of want it as high as I could get it. Because, like, I don't want the zero lower bound, quantitative easing, non-conventional monetary policy, including communication policy. It would be amazing for the world if they never had to use any of those again. Because they're harder than moving the funds rate and what it happens. So, and that's operational. But in general, it'd be like, this economy's healthier. And the U.S. is really, of our peer countries, is the only one that has got this scenario in the cards, right? Because coming out of this recovery, we've had much stronger growth. Productivity is stronger. Now, these things are hard to measure, but we're getting to a place where, no, this is pretty clear. This isn't just a 1 quarter thing. Now, I don't think that AI is already saving the U.S. economy's productivity, but there are things that have happened, work from home, and we had a labor shortage, so there's labor saving technologies out there, and there's a case that what we got in terms of growth and productivity growth we can keep.
Yeah.
But that is like, I thought this guy or like totally wildly optimistic and also often very depressed and pessimistic in private. But like the soft landing, like that should not have been possible if you were just like econ macro 101, like what they teach at Harvard. So like, but if you that shouldn't have happened. Just like banking on productivity to make the interest rate that the economy works at, like that the Fed isn't like disrupting, like pushing down interest rate sensitive sectors. I don't think we're gonna get it. I don't think the Fed thinks it, but I mean, really, if we had 2% inflation and unemployment below or at 4%, and we didn't see any weirdness in interest rate sensitive sectors, like I don't really care where it is. Like it doesn't. Like I want the economy that goes behind a higher R star than before the pandemic, because that was not as good of an economy as we have now. Mean reversion is a thing. Like the expectation is, because it'd be really somewhat miraculous if a horrible period in U.S. and global history ended up like pulling us out of a
Yes,
just
but it
kind of
looks
a,
like
it
it
wasn't
did.
like malaise. Yeah, I just that seems too hopeful. I don't know, but
I would say that there's evidence that R star is kind of higher. I mean, I don't think many people would argue maybe this is obtuse, but like R star is higher than it was, and that's part of the reason we're not in a recession actually. Because if the Fed was just let's say R star was 2% and we just knew it, then the restrictiveness of the current Fed, or let's say the Fed before they cut, and would have been much larger than if R star is 3 to 3.5, right? Then the restricted. And if the Fed was actually as restrictive as that would imply, as let's say 2% R star, we would have been in a recession. So there is some evidence, maybe, that R star is higher simply by virtue of the fact that we're not in a recession. That's partially the evidence.
yeah, because they would have if we were in a recession, the Fed funds rate would be lower.
Yeah.
The market rates would be lower, at least at the short end. Probably also some at the long end. No, these aren't. You don't get to just pull a variable out on its own, right? The R star it has so much bundled with it. I mean, that's why when people go through the estimation models and they have different factors they put in, I think they can come to some very, very thoughtful people who all they do, bless their hearts, is think about R star. Like, they come to some really different conclusions about it because it's very complex. Like, we want to know what is that number. We want to put the bets on it. We want to know, and it's like, I think Powell has done he's put in a lot of effort in his whole, like, oh, we'll know it by its works and da da da. I mean, but he's trying not to, like, say this is a made up number because you said they need a path. Like, I thought at Jackson Hole, he's like, the direction is clear.
That's right.
And honestly, we didn't have that fully articulated until that time at the end of August. So he's not going to promise what he can't say. It's like, I don't promise my kids it's going to be okay. I promise I'm going to fight really hard, right? So he can't promise us R star. See how they're so parallel, my life and R star. But like but I think he's been very careful about not throwing it under the bus. I mean, his vice chair of the FOMC, his the New York Fed president, Williams. I mean, that's John's bread and butter. Like in terms of both estimate, but being able to speak very thoughtfully about what drives it, and they do need a direction, and but we also they're also practical. They gotta make the decisions for the one foot in front of the other.
Yeah.
And
So let me ask you a question, Claudia. I got a lot of questions on that really substantial downward revision to payrolls, could you just sort of take us through that and explain to people, how did, because a lot of people reacted to that in saying, well, you just can't trust anything that comes out now because it's all overstated for political purposes, and then the real numbers eventually come out. Now, a point that we had on our last stream was actually, you should be really impressed at the robustness of this process, which is happening all out of the open, and revisions are expected, and they know when they're coming and all that. So, but you know more about this than I think most others. So can you just sort of take us through the process of getting to those revisions and what this particular one, was it as really monumental and earth-shattering as people made it out to be?
Right. Yeah, that was, the one thing that data-driven Fed has done for us is the amount of attention, at least an attempt to understand how data are produced, and then the amount of energy that goes into, like, messing up the message, right? Like, if you go more detail, you can also start to sound like finding some series on the BLS website and claiming they've stopped counting coffee prices and the CPI. And the BLS has to actually go on Twitter and be like, no, that's so like it's good that people care, but they don't really care. Like a lot of people are just, it is confusing. So I wrote a Bloomberg opinion piece a couple weeks after the preliminary revisions came out, and they got a lot of people's attention. On the data piece, I argue when we get large revisions, or when we get any revisions, I mean, like, frankly, like 10K on the unemployment claim seems to get people fired up, right? So, but like, that is a sign of our world-class data apparatus. Because for these quick numbers, like the payroll numbers for the months, the preliminary read, we get in like 3 weeks. And to do that, like, we can't every month do a census of the entire country and be like, are you working? Are you doing this? And, the businesses. So they start with a sample. And it's like, I don't know, it's in the like 28,000, I mean, it's like really small versus like 20 million, right? So it's like order of magnitude fewer establishments or firms participate in the survey, saying about people they've hired and fired and stuff. Whereas the U.S. population, we did a census, I mean the millions. Okay, so the reality is it's just like if you go out to dinner and you're sitting around a table with 4 people, or if you're looking at small clinical trial results, when you have a very small sample, you get a lot of fuzziness. Because it's just like 4 people had 3 different outcomes, and you do the math, and it's like, they're just 4 people. When you look at 4 million people who have that, like, you should expect, and any researcher would tell you, any data measurement person, to be like, there's a, what's it called, confidence interval, right? There's kind of a statistical band, and so, nobody, like, the 90% confidence interval. So that's like, you have the number they give you for the month they've estimated. They say, what's the chances, like it's 90% of the actual reality would be like close to this estimate number. For payrolls, it's like 130K, right? I mean, that's, now that doesn't mean that they're all off by 130K, but that's like, you should be prepared for some pretty big revisions. What we do in the US, and not all countries do this, is then we say, okay, well, that's really not good enough, right? We need something more precise. So then when they'll do annually, so we started with a survey, a small survey, but not like nothing. I mean, government surveys are better funded and larger than most private sector surveys. And so they're more precise, so they revise. So then they go, and these preliminary estimates, they are trying to estimate the same thing, like how much the payrolls change. And they actually do it over a year period, but it's totally not important for this. But then they go to the state quarterly census on economic QCE data. Anyways, it's like basically it's the unemployment insurance offices in the states, and those people, because they are like the bean counters, like that is supposed to be a census. Yeah. Now, of course, I mean, Goldman has a piece, well, but the immigrants don't. I mean, like, you can get like way down the rabbit hole, and I'm sure Ophir gets to hang out there, and anybody who does this, because you need to know, like, is what we're looking at that's a surprise, is it just noise? Or is it trying to tell us something? Mm-hmm. And so you got to know how the data are constructed. They don't just come down from heaven. Like, you have to do them. And so, but I think it was like 800,000 off the level in the March of 2023 or something, 2024. Like, I mean, that's big. It's not the biggest. And I think I haven't been following the blow by blow quite as much, because they'll bring in these quarterly estimates, even though they get revised, because more people get in their stuff. So I thought I heard once that maybe it was going to be, because they gave it a preliminary estimate. It doesn't actually go into it, and they do the benchmark revision until February. So yeah, I mean, this is like, anyways, but to me, the sign that we are out there measuring and have these other methods is super important. And if you go back over time, and this is what I think gave a lot of people who are smart on this some pause, including the Fed, one time when you can get a difference between the payroll survey and the payroll census, this quarterly census, is through turning points. Like, so the surveys, because they do an adjustment called the birth-death model, which, anyways, economists should not, or statisticians probably aren't good at naming things either, but it's just like new companies coming in and out, and a lot of people were concerned that in the monthly numbers, the census is getting a little like, oh, we have all these jobs being created, and what happens is you go into a downturn, well, there's less job creation. So if you've kind of got this fudge factor that doesn't get, trails off, then you can get, that's exactly what this process is supposed to catch.
Yeah.
That the survey and the, like, kind of the methods, like, these have been the same methods. They evolve and improve. There's nothing nefarious about this. There is nothing, there's a lot of boring things about it in terms of the details, and we could totally quibble with, I would have a lot to say about owner's equivalent rent if I had an opportunity to opine on it. But and there are many of us, and BLS actually does listen to those people. It's just you can't ever do it perfect, so what's the best you can do, and it evolves. But all that is good. The one thing I did flag in the piece that I found very disconcerting, and the BLS has got to get it cleaned up, is the data did not post at the time they were supposed to.
Yes, that's right.
At 10:30 in the morning publicly, and then what the deal was is internally it posted, and of course people in markets, I would be doing this too if I had money on the line, are calling the BLS to get the numbers.
Right. Yeah.
And people at BLS gave it to them because they thought it was already out. And so like that kind of stuff, I have no patience for. I blame the Fed partially. But I also blame the fact, and I think it gets reinforced by these data haters, is like these agencies have to be funded. they have to be considered. Like, we have world-class data, we should treat them like world-class statisticians, or they're going to go work for Google.
Yeah.
And so I think that's because to me it wasn't malice or it wasn't politics, it was just they don't have the resources, and there were some really sloppy mistakes made, and that wasn't the first data release that it happened with, and it will undermine credibility, it will undermine trust.
Yeah.
And like, we have got to have people take those surveys.
Yeah. The size of that revision with that timing, that not shared public but shared to institutions, that looked really bad. It just did. I'm not gonna go into some sort of conspiratorial. The optics were very, very. That was a wrong number to have those optics. Let me tell you, that was a wrong number. So
Yes, yeah, that one should have gone up because it was. I think it's true with the data people. Like, they don't trade in markets, right? So like, this is a data release that nobody has cared about. I mean, yeah, it's a bigger one, but like, it comes out at 10:30. Important data don't come out at 10:30; they come out at 8:30. So the apparatus wasn't ready. But it's like, come on, pick your head up. Like, they're all waiting to see this. It's the last data before Jackson Hole, and so they're just not. I think they don't want to be in this back and forth. They want to do the numbers, but like,
Right.
that's kind of like me going on Twitter and be like, I want to talk about econ policy, and I don't want any like unhappy people, politics, partisan hacks. I mean, like, you just can't. You have to find a way to cope with it.
You can't wish the world to be the way you want it. You have to accept what you're given, which
Yep.
is very different. And this is a media-driven market. It's social media-driven, and this stuff gets really, worked up. And yeah, I saw a lot of that when this was happening, and I've continued to see people who were kind of scarred by this process who think, it really impugns the entire data set, and it calls into question newer releases.
Yeah.
And I think the fact that it's interesting, the idea that this might have signaled, and the concern was it might have signaled a turning point, because normally you would think it would be a bit noisy, these kinds of revisions, and maybe net out to something much more meager, and this didn't do that, right? And I think that was telling. But from your perspective, you still think that we have a robust and strong labor market, and that it's not signaling anything too concerning. Is that a reasonable summary?
So it's been cooling off a lot. There's only one statistic that really keeps me up. That's actually my last Bloomberg opinion piece. Big gaps between. It's been hard to get pieces out recently, but it's on the hiring rate. So to me, the hiring rate is back down to like 2013 levels. Now, this is from a establishment survey, a survey of firms, that yet is a different survey from what we get on JobsDay. It's a smaller survey, and it has had some real, like, the response rate is like not going in the right direction. So I think it's so hard to lean on this thing, and the Fed has leaned on it, like Chris Waller's, like the job openings, and so you kind of got to go there. But the piece of it that I think is really useful, just in general, what it's doing, and this other researchers agree, is like what's happening to the hiring rate. And right now it's back to 2013 levels. We were talking about like 7-8% unemployment. That was when we were back in the bad recovery. So and if the hiring rate stays low, we are going to have the unemployment rate creep up some. Maybe it doesn't keep going, but we're going to see unemployment prints that are above 4.1, and we are going to see a negative payroll print.
Yep.
And the markets are going to totally lose it. And it'll probably be like not a real one, in the sense that like it'll just be the noise. You get towards the bottom, you're going to hit something. Like, you'll fall through, and we saw that even in the great job market right before. So I worry about that one, and the research. Bob Scheimer, the ins and outs of unemployment. So he's very well known for establishing that the moves in the unemployment rate, typically like during recessions, the moves are much more driven by the hiring rate, so not getting a job, than they are by the layoff rate. And that's important now because the layoff rate is at like rock bottom. I think a lot of that's COVID. Companies got burned from like laying off millions of workers within weeks, and then the customer came back faster, and they had to pay more prices. And so I think there's a real reason, a kind of post-COVID echo of why they're not laying off.
It's a really important point, because you do see headlines about layoffs, and you see people sort of glom onto those, but you're saying the actual numbers are that the layoffs are not happening on a net basis.
Yeah, it's unusual, and I think it was Barkin. One of the Fed officials made the point of like this like low layoff rate, like really low layoff rate, and a very low hiring rate. That is very unusual, and something is going to flip back into normal. It could be that, things are weakening and we're going to start the layoffs. I think there's a lot of uncertainty right now. Actually, I'll be interested in your earnings call questions too, because there could be a reason to talk about with the hiring rate that like you're uncertain about the rate path. And I think we can see some interest rate sensitive sectors have more of this. The hiring rate is really low, or maybe they did a lot of hiring during COVID, so it's low. And the election, like we have no idea what economic policy we'll have next year because we're still in campaign proposals, right? These are details, but both the House, the Senate, and the White House, those will be consequential in some way. I mean, with the Trump tax cuts expiring, like there are going to be changes in the tax code. Like there's no way they pass that through. So as a business thinking about, do I expand and hire more? I can get the uncertainty. So I think that's the hiring rate. I'll feel better when it stabilizes. And honestly, I don't need to see it necessarily come back to where it was before COVID. It's just the direction of travel. It's all about the direction of travel. And it's not, if it just flattens out, go for it. But I just, like, I don't know. And I guess the big data takeaway from this is now more than ever, when one is thinking about the macroeconomy, hearing these different stories, trying to weigh it out, you really have to look at multiple pieces of that particular, like the labor market, inflation, and you got to look across. Like no simple statistics. I mean, the Somro is one of them. Like I don't use changes in unemployment rate to make my we're not in a recession call. It's in there, and I'm very concerned about the unemployment rate and things in the labor market because I think the labor market is what kept us out of the recession.
Yep.
Mm-hmm. There was enough buffer to what the Fed was doing. We needed time to pass. Inflation came down. So we need that labor market, but I mean, if people had told me, well, you can only have one series, I would say, I want the unemployment rate, and I looked at the unemployment rate and say we're in a recession, and that we might get there, but we are not there. So anybody who goes and cherry picks the one statistic should get muted.
So Ophir, you said you not able right now to talk to CEOs of the companies that are going to report earnings, but you're talking to some of their vendors.
Yeah.
What's that telling you about the strength of the economy and which one of these might flip? But do you see, are you hearing concerns about demand and weakening demand, or is it a rosier picture? Are you said you're a pessimist, but how pessimistic are you right now?
So there has been for now a while on virtually every CEO call an embedded pessimism. And what's interesting is some of the companies I was speaking with, there's actually no pessimism in their numbers or their guidance, but they're receiving the pessimism. It's not, we don't live in a vacuum. So I would say the last time I spoke with them, it was more urgent than it had been. It was getting more and more urgent every quarter, basically. So that path hadn't changed. The last quarter I spoke with them, which was before a Fed cut, it was before Jackson Hole. But after the payroll number, that they were the most worried they had been. I don't want to use optimistic and pessimistic. So this emphasis on, I have this, okay, I think maybe I said this once before, but it's been a while. So usually when I'm speaking with CEOs, they tell the public, we can forecast about a year ahead, and maybe some of them are feeling very good about the business, and it's just a different kind of business. Let's say NVIDIA, they can tell you maybe 2 years ahead. They have the guardrails. And then I'll never forget it. It was in 2022, and I said, so how does the year look? Like, really, Ophir, I kind of can't look more than a quarter ahead. I said, okay. Mm-hmm. Then the next quarter I got on, I said, so how's the next quarter looking? I said, I almost can't look more than a month ahead. I was like, then the quarter after that, I said, how's the first month of the quarter, and they said, I really can't look more than a week ahead. I just stopped asking after that. But it's been flatlined there. So it'll be interesting for me to see. So to answer your question directly, in fairness, the last time I spoke with them before a Fed cut, after the jobs number and before Jackson Hole, they were the least optimistic they had been. But I was the least optimistic I had been. The market was the least optimistic it had been. So now let's see what happened. They always said lower rates will, sounds obvious, but it's nice to hear it, that it will support more investment. And supporting investment in the SMB world, SMBs can't just stand still. Apple can stand still. And SMB can't stand still. They're either shrinking or they're growing. They don't really have this equilibrium. Okay, well, they were in disequilibrium and they were shrinking. So we'll see. I'm excited. Also want to point out that when Claudia was talking about there's the hiring rate and then the opening rate and whatever, the populace responds to that with the quit rate. So you have like that other, since we're looking for more data, you can see the quit rate going down, which is emblematic of exactly what she said. It's like, people aren't, do you remember when the quit rate, they called it the Great Resignation? That ended fast.
Yeah.
Yeah, it did. Yeah.
Yeah. No, and I think the quit rate can be really helpful. Like, I think it's important for us to understand why the hiring rate has fallen so much and the layoff rate has not really moved. And you got to have those two pieces. But the quit rate, which is essentially workers answering the survey with their feet,
Yep.
to me, that one has a lot of skin in the game, right? Because those are voluntary quits. So yes, they track the pattern, the direction of the hiring rate coming down much more than the layoffs staying flat. So I think, and it also kind of underscores this, like, don't just pick the layoff rate, don't just pick the hiring rate. And yes, you're absolutely right I think that's a good one that kind of balances it out to some extent.
One of my favorites is that one.
All right. So in a couple minutes we have left, I'm going to ask you a totally non-controversial question. The election. You know what? I don't know even how to ask this, but obviously it's coming in, I think, 20 days, and it's going to have pretty significant macroeconomic effects. You know, what, without prognosticating on maybe it's not even possible who's going to win, but you know, like where are you concerned or optimistic in terms of what effects the election might have on the economy in the short term?
All right, I'll go, because it's such an easy question. I'll get me out of
That's
this.
right. Yeah. My cheat code is Claudia. So just
kind of just repeat. It's clear this is creating a lot of uncertainty, and one piece, like, the details matter with policy, and an important detail is who are the people that are doing the voting, like in Congress and at the White House, because if you have a divided Congress, which it looks in all likelihood we are headed towards that, right, and that would just kind of play out with, and probably close and right on the margin, you know. So even if it would go one way, it'd be a close one. So then you could have someone like Joe Manchin be like, I'm not going to do that, you know. So I think we'll have basically a divided Congress, and a White House going to be of one color or the other, and like, it's just going to be the gridlocky mess. Now, that in general, I think a lot of people look from outside of Washington and are like, that's the best we can do is they do nothing. And it's like, no, see, the doing nothing comes at a cost. You know, and so you don't have statistical agencies that are funded like they should be. You have programs that, like, if they had more resources, they could be more cost effective. You know, this kind of like, if we have, you know, agencies running stuff on 1950s technology, like IT, it's like, this is nuts. You'd have to make an investment and whatever. But instead it is it's very political. If you have a whole party that's like, we will not raise taxes, like, that takes a big chip off the table when you're talking about, you know, the deficit. And I think it worries, like, I do not like policy making by crisis. Right? Like, I got kind of on the Fed's case about, like, they didn't want to cut. And it's like, well, but, you know, we have the luxury of time with the labor market, and we can't cut big because it might signal we're worried, and blah blah blah. And, you know, even some of the very, like, dovish people were like, well, you know, we need to see a substantial deterioration before we cut. And it's like, if you wait until that long, you have waited way too long, because the Fed can't do it on its own, and the fiscal doesn't inspire a lot of confidence, and we certainly, even if they got help out, will end up with no better and probably worse setup on, you know, the federal deficit. And I am neither a modern monetary theory person. Like, I do think this matters in markets. You have to have market functioning, and you gotta have people that want to buy this stuff, and the demand is probably not limitless. And if nothing else, it creates uncertainty about the demand. And then, but I'm also not a deficit scold. Right? I really do not like picking, it's 100% of GDP. It's 120% of GDP. Like, there's no magic number. There are events we can think about that might take it to enough of a crisis that policymakers have to react. But there's no way that's, like, the best we could do. And there's really, neither party has any, like, let's have the tough talk about fiscal consolidation. And especially in the entitlement programs, they really will not talk about it. And it's like, you can't get anywhere to controlling the deficit spending relative to GDP unless you touch the entitlement programs. Like, you know, I think I'd be much more up for like bringing in some revenue and probably some taxes. But if you have a party that says absolutely no revenue, so it's like watching a train wreck. Now it is a train wreck we've been watching for decades.
A long time, yeah.
And the U.S. is very special, and it might, and the U.S. economy is very strong. Right? I think when you have it really fall all apart, you have a very weak country that has taken on a lot of debt. They're no longer credit worthy, and then it's just kind of like the house of cards. I don't think that's what we have, but that's the one. So it's kind of like I think doing policy making before the crisis is good. So I'm not really happy about a divided Congress, but that's what people want. That's what they get. But there's no leadership on like how you would actually do fiscal consolidation. Because I'm not saying that you should do it, but there's so little thought behind what we would actually need to do.
Yeah. I would say that it's really, I think the disaster, the impending disaster is the slow moving train. It's that nothing will get done in Congress. You asked the question about the election, and naturally you go to the president of the United States, but this is an election for Congress as well, always is, right? I would say the one thing that could save the U.S., well, that's a little bit too pessimistic. One of the things that could save the U.S. if we get into a disaster is that the House, I mean, hypothetically, turns over every 2 years. I know incumbents always win, but I'm just saying, if something really, really, really went wrong and we needed, and the populace had agreed we need to do something, look, the House turns over, the whole House hypothetically turns over every 2 years.
Right.
That part of our Constitution might actually save us. So, so I'll just say that there is one chamber of the legislative branch that turns over virtually immediately. So maybe that's it. I think we will have a divided Congress, and therefore I don't think the president will be able to do as much as the president, either candidate, says they will do. And I don't know how much they're saying they will do is the truth anyway. I don't even know if these candidates at times understand what they're saying. They can't be experts of everything, and at times they kind of seem like they're experts of nothing. So I just blasted everyone. So, but I think it's a slow-moving train that could be the disaster. Other than things that you can do with an executive order, like tariffs, for example. So you could talk about that.
All right. Well, I'm gonna take that as our closing note, and I'm gonna add something to it because I totally agree with you, Ophir, on the beauty of the potential to turn over the House on a regular basis. The problem currently, of course, is gerrymandering, and the solution is actually on the ballot in a lot of states. So if you're listening to this, and one of these voting reform acts is on the ballot in your state, such as ranked choice voting, or the top four, regardless of party, get on the ballot instead of these extreme primaries, think about voting for them. Like local electoral reform is happening, and it's really important, and it will lead to, I think, a much stronger and more fulsome democracy. And it's in everyone's interest to get away from this extreme partisanship and polarization, and that's one of the ways that we can do it. So on that note, also make sure you're registered to vote. Pretty important election coming up. Claudia, Ophir, thank you so much. As always, this was fascinating and insightful, and we've got a lot of people listening. So clearly, the general populace agrees on social media. So we'll have you guys back after the election, maybe before the end of the year, to see where we're at going into next year.
Awesome. Thank you, Dave. Thanks.
All right.
Nice to see you.
All right.
Thank you. Great to see you, and good luck with the treatment, Claudia. We're all here for you. So. Thanks, everyone, for joining us, and we'll see you next time on Let's Talk Markets Live. All right, and it'll take